What is going on, everyone? Welcome back to another video. So I know a lot of you have been asking about options trading, and I haven't really made a video on that yet. So this is gonna be it. This is the video where I teach you guys everything about options trading. So, well, not everything. I'll try to get through a lot of the things, but it's gonna be a pretty long video. So grab some popcorn, grab some snacks, and yeah. I know a lot of you have probably seen those people that make they take from like $1,000 to like $100,000 and like those crazy gains. So yeah, for options trading, it's possible, but it's very unlikely that you're going to be able to make some huge profits like that. More than likely, you're probably going to blow up your account if you try doing that, and you'll end up pretty much broke, and you're going to lose all your money if you do that. So yeah, I'm going to get into talking about options trading now, and hopefully you guys stick around, and hopefully you guys learn something new, because I'm sure a lot of you don't know what options trading is. And yeah, so I'm going to try to explain as best I can. If you guys have any questions, feel free to drop them down below in the comments, or just message me if you guys know me. And yeah, let's get started. So I use Robinhood. I'm pretty sure most of you guys know that. But even though it's not like the best platform to use for like options trading, I think it's easiest for me and like a lot of new beginners that use it. And yeah, it's easy to navigate. It's pretty simplistic. It's basically self-explanatory once you understand what like options trading is. There's no contract fees either. So like I know on TD Ameritrade they have a contract fee. So like for each like options contract that you buy, like they take a portion of your fee. They take a portion of the profits that you make from it. And yeah, so basically, what is an option and how do I start options trading is the big question, right? According to Investopedia and Google, it's the contract is which gives the buyer or the owner or holder of the option the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. So I know that sounds very complicated, but trust me, it's not that complicated as it sounds. So basically, an option contract in simple terms is a contract that consists of 100 shares of a certain stock, whether it be Microsoft, Apple, any stock you name on the stock market. It's 100 shares that allows you to trade, and basically it's one contract of those 100 shares. And on Robinhood, I know that you have to go through to the settings, and you have to click on you have to enable options trading if you're new, and it shouldn't be that hard. I'm pretty sure it's like you just turn it on, you're allowed to trade. But I know for like some of the other things like spreads and stuff, you have to be like a little bit more knowledgeable on that. So you have to have like some experience on trading options before you can get into spreads, I think. Yeah, so what are the pros and cons of options trading? These are not like all the pros and cons, but these are some of the ones that came to the top of my head. One of the pros is that options contracts are a lot cheaper than buying 100 individual stocks. So for example, like a contract of Microsoft could be 110, which would be 110 times 100 because it's 100 shares, which would be $110. But if you were to buy 100 shares and say the price is 200, that would be $20,000. And I'm sure a lot of you don't have $20,000 just sitting around to buy Microsoft. Yeah, and also like I said, options trading is a lot easier you can more easily make those crazy gains, but at the same time, you can lose all your money too, because when an option expires out of the money, it's going to expire worthless. So that's basically one of the cons that I wrote, is that you can lose all your money and blow up your account, and you'll end up losing all your money basically. It's a lot riskier than trading the stock itself too, because like I said, you'll be losing all your money if you don't make any gains. And most people, they don't hold till expiration. So yeah, I'm sure I'll explain more in the video, but basically like it's a lot more riskier than if you were to trade stocks, because a stock, like if you own it, like if it drops down in price, it can still come back. If in options trading, it's a lot more different than that, because there's a lot of different things that the price depends on. So yeah. So for the types of options, I'm just going to be talking about long calls and long puts, which is like the most like basic call input. So a call option is basically where if the price of the share goes up in value, the price of the premium or the price of the contract itself will go up, most likely, depending on the other things that we'll talk about, and that'll basically be profit, like if you were to buy low and sell high. That's basically what it is. Now on the other hand, there's put options too. The put option is basically like the exact opposite of a call. So if the price of the actual stock decreases, you'll make money on it. So in a put option, you basically want the stock to go down in value, is what you're saying. So like if I think that Apple is going to decrease in value like in the next week, I would buy a put contract. So basically I think that the price is going to drop and then I'll make money from that. And there's also those other factors I was talking about, like we'll talk about later in the video. So how are the options priced? When the options are in the money, like in stock terms, that means that the price of the actual stock is below the strike price of the option. And so, for example, if Microsoft is trading at $200, then a contract that has a strike price of $190 would be considered in the money. And in the money contracts are usually going to be a lot more expensive. Well, not usually, they are going to be more expensive than out of the money options, because like just think about it. If the strike price is $190 and the actual price is $200, you're already above the actual strike price. So you can exercise the contract and you could sell them for $200. But that $10 difference is still not going to make you profit, because you're still paying for the premium of the contract. So you can't just buy it and sell it automatically and you'll make money. That's not how it works. So yeah. I'm gonna explain the Greeks. You still have to know them to understand what's going on with the prices. So some of the key vocabulary that you're gonna need to know, like for the whole video, I guess, is what a premium is. Premium is just the price of the actual contract that you're buying. So if you're buying like the Microsoft like 110 priced option, that's a premium. And then the implied volatility, you're gonna need to know this for Vega when I talk about the Greeks. Implied volatility is basically supply and demand impacting the price of the option. So like the higher the implied volatility, the more expensive the contract is going to be. And usually when there's earnings coming out, a lot of the times that's when the implied volatility usually increases. So like if you buy a contract right now and the stock price like goes up, even if it's a call contract, if the implied volatility decreases, the price of the contract is going to decrease regardless. For the Greeks, it's a little bit complicated even for me, like I said. But so if you don't understand right away, don't worry. You can always look it up on Investopedia or just watch another YouTube video on the Greeks. I'm sure other people can explain a lot better than me. But so theta is the first one that I want to talk about, which is basically time decay. It represents the rate of change, the option price, and the time of the option. So it's basically how much the price changes each day passes on the contract, and the closer it gets to expiration, the less the contract is going to be worth. So for example, if a long call contract theta has negative 0.5, that means that the contract would theoretically decrease by 50 cents or $50 if you do 50 cents times 100 shares per day, assuming that all the other variables or the other Greeks are held constant. So basically theta, you have to know that, because if you buy a contract that expires this week, the theta is going to be really high, because the further the expiration date is, the more likely the stock is to increase or decrease in price. So theta is going to be a lot higher if you buy a weekly contract, like if it expires this week. That's why those contracts are going to be a lot cheaper, because the risk is a lot higher and the probability that it goes out of the money or like it changes is going to be a lot lower than if you were to buy further out. If you were to buy a further out expiration date. So if I was to buy one next week, it's going to be a lot cheaper than if I would buy one that expires in December, basically. Okay, so for delta. Delta is the rate of change between the option's price and a $1 change in the actual stock itself. So if delta was 50 cents for a long call, that means that the option's premium would increase by 50 cents or $50, like I said, 50 cents times 100, if the underlying stock increases by $1. So if Microsoft stock increased from 159 to 160, then if the delta was 50 cents, that means that the contract would increase by $50 and you'd make $50. And the same thing works the other way too. If it decreases, then you lose $50 basically. It also, like some people also use it to determine the probability that the contract expires in the money. So like if delta is 0.5, that means that there's a 50% chance that the contract expires in the money and you make a profit. And then, yeah, so, I mean, if these all make sense to you right now, don't worry, because a lot of the times it's not going to make sense to you, like, on the first go. Like, you have to, like, read it over and over again. Because I didn't understand them the first time either, but I just kept, like, looking at what it was, and it gets a lot easier once you know what it is. Okay, so for the next one is gamma. Gamma is basically the second derivative of delta, which is, like, it's like another tier below it. So It's like if delta were to increase, if delta, it basically determines how much delta increases or decreases by. So it's the rate of change that delta compares to the asset price, which is the second derivative, like I said, for all the math geeks like me. Like for example, let's give an example. If the gamma of option was 0.10 or 10 cents, then the delta and the delta is still 50 cents like we talked about earlier. Not 50 cents, 0.5. It's not money. But if the stock went up if it went up $1, then that means that delta would increase by the 0.10. So that would make the new delta 0.6. That's how it works. And it also works the same way the other way too. So if it decreased by $1, then it would make the delta 0.4. So like the Greeks basically determine how the option contract is priced. And it's not really important for like beginners, but like it's also important at the same time, because like if you don't understand what the numbers mean, then like you could be buying like a super like not a low probability contract, and there's no point in wasting your money on that, because there's a high chance that you're going to lose your money from that. Because if you don't sell right away when you make profit, then there's a pretty high chance that you're going to lose the profit, because the option contract expires worthless, like I said, if it's out of the money at expiration date. Okay, so for Vega, this has to do with implied volatility. Like I said, you have to know what that is. So the rate of change between the options price and the assets price, and the assets implied volatility, not the price. So if the Vega value is 0.10, then the price of the contract will change by 0.10 with every 1% change in implied volatility. So if the implied volatility of Microsoft stock went up by 1%, that would increase the price by 10 cents. Is basically how it works. But yeah, so those are the four main Greeks that I usually look at. There's also rho, which has to do with like interest rates, but I don't really know, like I don't really understand it that much, so I'm not gonna try to explain it. But yeah, so now I'm gonna open up my phone and I'll show you guys an actual example of like buying and selling a contract, which I'm sure a lot of you want to know how to do. So yeah, let's get into that and I'll show you guys what that looks like real quick. Okay, now that I've pulled up Robinhood on my phone, I prefer using Robinhood on my phone because, I don't know, just preference, I like using it on my phone. So basically, I'm going to teach you guys how to actually buy and sell a contract. I think I'm just going to be doing long calls today. It's the same thing with puts, but it's just puts you think that the price is going to decrease, as I explained earlier. So we're going to go through and try to buy a contract. I'm not going to actually buy it because the markets are closed right now on Sunday. So I'll show you guys exactly what to do so you're not confused, but yeah, let's go. So right here, you hit trade. It's gonna pop up. If you don't have the options enabled, like I said earlier, you have to go into settings. I think you go to investing or somewhere. Just look through, yeah, right here. You go to options trading, and then I think it has like the option to like turn on options trading or whatever, and you turn it on, and then you go. And then when you hit trade, there should be an option where you can click on to trade options. So you click on that, and yeah, so it shows you you buy a call, high risk, medium risk, well, some risk. So like the further out of the money you go, the more risky it's gonna be, because it's the less likely it is to hit that price. So we're gonna look at say we want to buy a contract for August 28th. So each of these options, like the option chain, it expires every Friday for most of the stocks. So say we want to buy one for August 28th, which is 3 weeks from now, which is a good amount of time. It's not super late. It's not super far out, like the expiration, but it's not super close either. So let's go on August 28th. Say we think that the price of the option is going to hit $215. So right now it's trading at $520 or 520 times 100, which would be $520. So say we think that it's going to hit $215, right? So we click on it, and it's pretty simple. You want to buy one contract, right? Or if you want to buy more, you can, but let's just say you want to buy one contract. It says that the limit price would be, the bid price is $510 and the ask price is $530. So the price that shows up in like recommended is going to be the mark price, they call it, which is going to be the average of the bid and the ask price, which is most likely where you're going to get filled. If you don't get filled, or if someone like doesn't, if that means like if someone doesn't take your order, then you can replace the order, and you can change the price to be closer to the ask price, which is going to be more expensive for you, because that's what the person who's selling the contract on the other side is asking for. So you would have to be more closer to the ask price. But for Microsoft, since it's such a high volume stock, you're most likely going to get filled if you just use the mark price or maybe even lower. Someone might meet you lower. So say you want to do that, and you can just leave it at 520 right now. And yeah, basically that's how much it would cost for us to buy one contract. And so basically the $215 is the strike price, what we call. So you think that the price is going to hit $215 by August 28th. And if it doesn't hit that price by August 28th, then basically you lose all $520. That's why options are so risky, because you either win money or you're going to lose everything if you don't know what you're doing. So say the price increases say the price does hit $215 by that time. The contract is most likely going to increase in value if the stock keeps going up in value like until that date. But the thing is, if Microsoft does drop to like $205, let's say, because of the Greeks and how the options chain works, the value of your contract is basically going to be like ruined. You're going to lose a lot of money. You're basically going to be broke. Not broke, but like the contract is going to become basically less worth. It's going to have less worth than the contract, and you're probably going to be losing a lot of money. And the chance that the contract increases in value is going to be a lot lower, because it has to come up a lot more in order to hit the $215 strike the mark. Okay, so if we click on the drop down arrow from limit price, it's going to show you like all the different details about it: the implied volatility, the chance of profit, and delta, gamma, theta. So like the chance of profit is like basically the chance that you're going to make profit out of it. But the thing is, that's not guaranteed, because you have to know when to sell and when to buy it. So yeah. So the break-even price, it shows you right there too. It shows you theta, gamma, delta, vega, rho, all the Greeks, like we explained earlier. So if you guys want to look at that, you can look at that. And yeah, so basically all you do to buy the contract. Let me talk about what that break-even point is. So when you look at the chain, the $215 call has a break-even of $220.20, right? So that would be the difference between, if you take the strike price and subtract the share price right now, and you add the premium to that, that's what the break-even price would be. If the option doesn't hit that price by expiration, then you're going to lose money, basically. So the premium is how much you're paying to buy the contract, and then the break-even is how much you would need to make the premium, and more than that. That's the break-even price. So we go back to the contract and we click one, you click on check mark, and then you would swipe up to buy it. But I'm not going to buy it right now. So basically it tells you that you're paying $520 to buy $100 shares of Microsoft at $215 each by August 28th. So basically it explains what happens at expiration if the shares aren't higher. If the share isn't higher than $215, like I said, it's going to be worthless. That's basically what it's saying. So basically that's how you would buy it. And then if you were to sell a contract, you would just click on it and then go to sell, and you just sell it to close it. It's not real. It's like just selling a stock, basically. It's not very complicated. And yeah, you can't trade options after hours or when the market's closed, so I can't buy right now. But yeah, so hopefully that helped you guys. But if you guys have any questions, feel free to drop them down below. I think I covered everything that I wanted to. And yeah, make sure when you trade options, don't trade companies that are like very low volume, and like those pump and dump companies. There's a very high chance that you're going to lose all your money if you trade those pump and dump companies, like the SPAC companies, like the blank check companies. That's what they're called. If you trade a lot of those like hype stocks, you're not going to make money most likely unless you get in on it before it spikes up. So I would recommend to stay away from those, and penny stocks too, unless you know what you're doing. But I tend to stay away from those because I usually lose money if I do that, and a lot of people have as well. So yeah, so hopefully this video helped you guys out. If I'm forgetting anything, let me know, or if I said something wrong, also let me know. I won't be offended. And yeah, so hopefully you guys enjoyed the video. Make sure to give a thumbs up, subscribe, and let me know what other content you guys want to see. I'm thinking about doing a video on spreads as well in the future. So if you guys want to see that, feel free to drop down a comment and let me know. And yeah, stay tuned for the next video. Peace out, guys.